Amazing. Thank you guys so much for coming. I am especially excited about today's panel because it is an assembly of three friends, three people I have had the pleasure of working with. From my perspective, I, for the last few years, was head of strategy at Layer Zero Labs and am now a venture partner at Bain Capital Crypto. I also trade and have used all three of their products. What's really special? What did he say?
Going?
How's it going?
The trading.
Just backstage, we were talking about how my summer went, and with a lot of free time traveling around Europe, I was trading meme coins, and I lost a lot of money on Jupiter. So,
How was the trading experience? Was it good?
It was quick. It was good. Yeah, it was. I used it within Phantom. Yeah. But this is also a really special arrangement because these are three founders of protocols that actually do move and determine the pace of DeFi acceleration based off of the decisions they have to make each day, hard ones. It's not easy running a protocol. And so throughout the panel, my hope is that we'll be able to cover and dive into specific stories, hard trade-offs they'd have to make, and also how they interact with each other. So yeah. I'm going to kick it off by asking each of you to give a very brief description of your protocols. So Zaki, we'll start with you. Sommelier, of course, is DeFi yields on ETH, powered by Cosmos. Could you share a little bit more?
Yeah, so I think one of the things that we got, so like Sommelier, it's a protocol, myself, my co-founder Christy, we've been working on it for about 3 years. High watermark TVL is 100 million. And we sort of wanted to build a system that would safely generate yield for users. I think like the last cycle, we saw a lot of seed DeFi that onboarded capital, but like rugged all of the users. The vision of Sommelier was to build something that felt a lot more crypto native, but gave that user experience of deploying your capital, getting sustainable yields without having to constantly be optimizing, moving your funds from one farm to another. As the market has evolved, you've sort of seen like strategies play a larger and larger role in the DeFi user experience, especially in the Ethereum EVM landscape, though you're starting to see similar products on Solana, where users can deploy their capital and it becomes a liquidity provider for the lending protocols. It becomes a liquidity provider. So rather than protocols having to sit there and micro optimize their incentives so that they can get their Discord chat to move their money from this lending protocol to that lending protocol and this DEX to that DEX, you can just have you can incentivize people to use a vault. And so you're seeing this more and more across crypto as the sort of vault thesis plays out. When we built this thing, I wanted to also sort of experiment with the idea of integrating Cosmos and Ethereum into a single user experience. So from our users' point of view, they're just using Ethereum, but they get this safety property where there's it isn't just a glorified multisig. There's actually an app chain behind it, sort of doing a bunch of things to protect users from potential things that could go wrong in a strategy environment.
And we'll talk more about Cosmos throughout the discussion. Zaki, in a lot of ways, is I would say, the father of Cosmos and has a lot of side projects. So I'll definitely ask you about that. Now, Meow, of course, you're one of the co-founders of a top trading platform on Solana, Jupiter. Could you share just a little bit more about what you do beyond just spot trading?
Yeah, so we are Jupiter. We are a trading platform. We can do spot trading. You can do perps trading. We can also just Launchpad, and we're also the largest decentralized community and DAO in the world. Yeah, so you can participate and have fun. Yeah.
Amazing. And then Cindy, you founded Drift back in 2021. It's been 3 years now. Drift is an entire DeFi platform on Solana. You guys have made some really big announcements going far beyond just a perpetuals exchange. Can you share a little bit more?
Yeah. Hey everyone, I'm the co-founder of Drift. We were founded in 2021 as just a simple VAMM perp exchange, which had one feature: you can long or short anything with 10 to 20x leverage. And since then, we've grown to label and become more of a decentralized DeFi infrastructure for capital efficient DeFi. And what we mean by this is we see Drift more as a pool of capital on top of which products can be built. We currently have about 500 mil TVL. We have one of the leading perpetual platforms on Solana. But beyond that, we also have borrow lend. We have vaults that generate native yield on Drift. And most recently, we also launched prediction markets. So you can actually trade real-world outcomes on Drift with this like unified pool of capital as well.
I think people often forget that Solana has actually only been around for a couple of years, and that consumer DeFi has been around actually in a usable state for even less. Zaki, you've been building in the space for, I don't want to age you, maybe a decade?
A decade, yeah.
Could you share a little bit more about some of these watershed moments or like tipping points that actually have led us to where we are, either pulled us back or put us forward?
Yeah, I mean, I think one thing that I think is probably the most surprising aspect of it is how much of DeFi has kind of it's this weird hybridization of like advanced protocols and things that are being built on top of like very like simple primitives. Like, you know, there was a time when, you know, first we tried peer-to-peer lending and we tried order book trading, you know, on chain. You know, there was.
And when was that?
Well, this was 2018.
Okay.
2018 was like, you know, ETH Lend, which is what Aave was called before it was called Aave. 0x tried, you know, was building like an, you know, an on-chain or an off-chain order book that executed on-chain. And in a lot of ways, you know, and then those ideas didn't work out. Then Uniswap happened, and we had, you know, an enormous explosion of tokens. It is amazing to me, I think, like, one is a lot of the themes in DeFi just repeat over and over and over again. You know, what we see on Solana now is, you know, at least the early generation of Solana meme coin liquidity is all just, instead of having like, you know, a chain that can support, you know, like a couple of hundred liquid Uniswap V2 style chains, like pools, you instead have hundreds of thousands, but they're still the same math. So all of those things are important. I guess like where I would say, like things that are exciting to me is that like cross-chain DeFi actually works. Like people are frictionlessly moving funds from Cosmos to Ethereum to Solana. And from a user point of view, these things feel way more unified than they've ever in the past. DeFi is liquid, it's usable. I think the hardest part though about building right now is DeFi is no longer sexy.
Finance should be boring though. Finance should be boring. Finance, yeah.
Yeah, it does feel a little bit like boring finance stuff, right? Yeah, like we are boring finance nerds building boring finance infrastructure, and the sexy stuff is like the meme coins that get launched on it. But if you didn't have DeFi, there would be none of this.
You could argue that now there are three categories of DeFi that have actually found product market fit. I think of those as derivatives, money markets or lending and borrowing, and stablecoins. Both of your protocols are in the derivative space, and you guys touch various parts of those three categories. Have we actually found product market fit? What does that look like? And you talk about DeFi not being particularly sexy. Like, do users want sexy? I'd be curious to hear particularly from you two, since both of your protocols have hit this inflection point recently, what is it that you've seen that gives you confidence in your protocol?
Yeah, I think one of the key indicators we look at is trading volume against centralized exchanges. And I mean, this chart has gone around for years, like DEX to SEX trading volume. To me, finding product market fit in the DEX world looks like that chart continuing to go up over time. Right now, we're trending at like 4%. If DEXs could actually get to 10, 20, 50% of centralized exchange volumes, that means that a lot of the on-chain economy would have been bigger than centralized exchanges. And that's a sign of success. Another sign of success is the growth of stablecoin market cap over time, because that feeds in, that tells me total inflows into the crypto space and total money that is going to be choosing the on-chain economy versus non-on-chain economy. So that's a leading indicator of like future usage of DeFi. And like right now, stablecoin market cap is something like 40, 50 bill. We want to see that continue to grow as we look at what PMF is.
So you're looking at the overall growth of the on-chain economy by measuring it against centralized exchange activity. I'm curious for Jupiter, how are you guys measuring product market fit for your specific platform? And of course, whether there is an upcoming token launch or not for a protocol can often drive misleading metrics. You've been working on Jupiter for a while. Can you talk about that?
Yeah, we are not it sounds crazy, but we are not a very like metrics-driven project. We are not. We don't really care. We care a lot about the user experience and what people say, right? I think for a very, very long time, for like the first 3 years of Jupiter, we have one metric, right? Which is like, how much do users like us, right? That's it. We didn't care about volume, like user growth, any of that stuff. We just cared like solely on one thing: how much do users like us? And we think that's actually very important because like as a DeFi system, right? You are so constrained by your macro ecosystem, right? Whether it's Solana or like crypto or the whole growth of tokens, right? So you can't do anything, you can't do much there, right? So what you do is that you really focus on what you can control, which is like within the realms of your power. So that's what we focus on. And the other thing that's actually really important for us as a protocol building space is that we like boring, right? I mean, the problem is this, right? One of the fundamental problems of being a crypto founder is that what users want is boring. They don't want fancy stuff. They want things to work, right? Like when you go to Jupiter, you don't want fancy. You don't want animation. You want your things to go through, right? But investors love fancy. Love buzzwords. They love like crazy stuff. So I feel like we are at this very weird place right now, whereby as a founder, you want to make things as boring as possible, right? And as understandable as possible. But on the other hand, there's actually a lot of like alpha, in terms of like hype and like making things fancy. So I think for us to try to do both, I think for us we really focus on making the user experience as simple as possible, right? But on the other hand, we do try to kind of like find the one or two things that can maybe pop. Yeah.
That's fascinating. There's this tension between investor interest in your protocol token and then the user experience and actual product that you're delivering. I'm curious, what do you guys think about the role of venture capital and whether it has pushed DeFi forward or pulled it back, particularly because the sentiment around token price, I personally think is very often influenced by activity from VCs. This is me going off script, by the way.
I can quickly start. I think it's important to build, especially, three of us are part of token launch projects, to build a really good capital base of holders within your project. And whether that's like venture capitalists or token or users of your protocol, I do think that the pendulum shift is always best when the token holders are actually users of your protocol. And a lot of, at least our experience with venture capital firms are that they are the ones helping to provide liquidity within the DeFi platforms as well. So it is important to not discount them as like asset like holders and members of your community too. That's how we see them. There's kind of no distinction between like, hey, you're a VC versus you're just some guy who holds $10 of this token. We would see you in the same way.
Did you guys raise venture funding, Jupiter?
For a previous project, we did. Yeah.
Oh, okay.
So first of all, I want to be very clear on one thing. I love VCs. I love them. VCs are so important, right? No, seriously. It's like I think how is a bunch of like couple of kids gonna find like venture funding? How gonna build a team? How gonna build RPCs? You can't get a shit about VCs. It's not fucking possible, right? So I love VCs. For all you VCs out there, thank you for doing God's work. Okay, we love you guys. But that's just a big bun, right? Right. The unfortunate reality of it is that like there's this game that VCs are playing to pump each other's backs, right? And very often it involves like like doing private rounds at increasingly valuations that compel a project to eventually get out there, right, with high valuation, right? So I feel like and then the other very tricky thing about VCs obviously is that the value add becomes less and less obvious, right? Because for example, say you're working in TradFi, right, or they're working in pharma or big biotech, right? The VCs provide a crucial role, right, from being like a development stage into the go to market, right? But then in crypto, right, your go to market is the community. So where VCs are not that helpful there, right? Which is why you do see the shift from Twitter influencers becoming VCs. Right, and the main value add for VC being like noise, So I feel like those two things are kind of unhealthy, right? Whereby the need to kind of like make your portfolio look good. The secondly is that like the unclear value in many of them, right? So I feel like I think personally what I want to see is that I want to see flatter rounds, right? That means that low valuations and you're done. You don't need to, and we shouldn't encourage activity where founders just go higher and higher and higher, right? That's one thing that we shouldn't encourage. The other thing is that I do want to see a lot more like domain expertise VCs, right? Whereby they really contribute like deep like technical ecosystem like expertise, not just pump, right? And thirdly is I think very important for VCs is that I think they have to be embedded with the community. That means that they can't be the adversary, the PvP thing between VCs and retail has to be resolved, right? So those are the melt, and we will see those two melt. So in summary, I love VCs. I really do. I wouldn't be where I am without VCs. But I do think there are some like really big structural changes. Yeah.
A question that VCs often ask is, where are the builders? I think in the context of this panel, an interesting question is, where are the DeFi users? Saki, we talked a little bit about this backstage in regards to how you can even break through the noise, what indicators there are these false indicators? I'd love to hear your thoughts on this.
Yeah, I think like one of the hardest parts of being a builder in DeFi is that you get very little signal about what products people want, what you should be building, what are like that. So if you imagine like what is the TradFi user or even centralized exchange user, like a Robinhood user, like the entire user journey through the app is something that like is measured, cataloged, and available to the dev team. Like they know all the pieces. If you are a DeFi builder, the user journey touches, even if like you control a front end, touches like one fraction of that front end is only a small piece of like, how did the user get funds onboarded? Like, where did they come from? How did they find out about your app? Like, how did they decide to do this interaction? Like you have you are operating in such a noisy environment. And the other thing that's hard about DeFi is like the DeFi dev cycle is slow. I mean, you are dealing with hundreds of millions of dollars of other people's money. And you don't, I've been doing this for 5 years and I've never lost anyone else's money. And like every time I look at a little notification on my phone, I'm like, is this the day? Right? So the dev cycle is slow. Testing hypotheses is expensive and time consuming. And the signal you get from feedback is like extremely high noise. And then when something works, you don't even really necessarily know why it worked. It just sort of, it did. And and you do get to talk to some number of users that are like active in your Discord and everything. But most people who show up are just like, how do I claim my farming rewards, blah, 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 blah. Like you don't get any other data from them about what they want, how to retarget them. It's an extremely challenging environment to build in, and trying to find those user growths, like those veins that you can follow to grow users is incredibly challenging. And I think you guys have both done incredible jobs of like finding new veins. I think like the prediction market thing is like such a
so just to add a really quick point here, right, is that the users, they get excited about anything that's a token, right, or sounds cool, right? But good DeFi programs, like good and innovative DeFi programs, are really hard and especially to build and secure and audit, right? It's not like it's really hard to do, right? So you have this weird combination of users telling you all kinds of things. Oh, I want this, I want that, right? But they don't actually want it, right? And then the path to developing it is also very, very expensive. So there's this weird thing that I think he pointed out on the head. Yeah.
I'm certain, particularly from my own experience building Layer 0 as a protocol, that when you make a decision to allocate resources towards a new feature or a new product, you are dedicating multiple months to product research, dev cycles, and then smart contract audits. Saki was talking on security concerns. When we talk about decade of DeFi, are we there yet? Some of the biggest watershed moments pulling us back were hacks and loss of user funds. My question for you guys is, each of your projects have announced a new feature or some product that I hope or likely was informed by user demand. Talk to me about a difficult decision you had to make in the trade-off as the founder or leader of the project, especially with such little information, like you said.
I think to touch on the previous point on like really slow dev cycles, there is a way and an in between there where the smart contract itself takes a really long time, but the front ends and the ways that users access the product can actually be built very quickly once you have a really good smart contract base. So one example here is that when we built our V2 to go from a single perp dex to a cross-collateral engine, that cross-collateral risk engine was entirely built in Solana. It took us like 6 months to build and ideate, and I think our devs like didn't sleep or see the sunlight for 6-7 months, right? And from there, we found it much easier to launch like products that focus on the front end side because we had spent that 6-7 months like so deep in the smart contract cycle. So I think there's kind of a trade-off there where spend a lot of time on the smart contract side, but spend very little time on the products that are built on top of it. Because, like for instance, when we launched Bet our prediction markets a month ago, that was a UI experiment for us that took some work on the back end. But to us, it's a short cycle experiment. If it graduates from an experiment, great. We'll build an entire team, product team to expand it forward. And we're seeing signs of success there. So basically, cheap and fast experiments can still happen in DeFi, but to me, that's on the product innovation front.
How about you, Meow? I think Jupyter, I've been familiar with Jupyter and have used it over the years, but feel that last fall, last summer, it really, really took off. Were there decisions you guys made as a leadership team that, I'm sure were difficult and involved trade-offs that you think has led to the enormous escape velocity success?
The word leadership is weird to me. I'm a cat, right? So I think, like in all honesty, I feel like it's a combination of just like really thinking about what users want, right? I mean, we are like, okay, users want boring. I'm not even kidding. Users want boring, right? So we are like, fuck it. We're not going to do fancy stuff, right? Users want boring. We're going to make it as boring as possible, right? So for example, one thing that we worked extremely hard on was slippage, right? Dynamic slippage, right? Because when the user set slippage very high and stuff, right, it's very problematic because they get direct, MEV comes in, lots of problems, right? But they always do it very high. Why? Because they get transaction through, right? So, and in fact, some users also set like 5% when you're doing stable coins, right? It's kind of stupid, So we innovated, we experimented like crazy, right? Just like experimented for months and months to get the exact UI right. And now it was really well now, right? But it sucked for a long time, right? But that was an example of a boring thing that we did, right? Just because we think that it makes it better for the user, right? Another thing that we did was that, but there's also the other side, right? Which is like the cat side. So there's the user side and the cat side, okay? The user side is all user focused. The cat side is just, whatever is fun, we just go, So we do that. Like we like all our projects are like so there are things that we do because it's boring and for the user, and there are things that just sounds fun. It could be like someone wants to try it, right? It can be like engineer and team that goes like, I want to do this thing, let's go. So yeah, so I think we do two things. Yeah, because think about it, right? Now, here's my philosophy. Nothing works. We don't know what works, right? So what you do instead is that you kind of empower people to do stuff, right? Yeah. So either you do, okay. So there's two things, right? There's a theory of exploitation and exploration, right? So you have things that you exploit. You know it's going to work. You know people want it. They're going hard on that, right? And things that you don't know, fuck, right? So what you do is that you just let people do it. So that's how we do it. The human side and the cat side.
So approaching protocol building from a like boring first perspective, of course, you can be more
and a
playful.
Fun first perspective, yes.
Yeah.
Boring first and fun first, yeah.
Because I know you, and you're a fun guy, and they have like cat debts, and there's spontaneity for sure. Yeah, you're welcome. I want to understand a little bit more. Building an enduring protocol, Zaki, there's a debate right now around building on an L1 or building on app chains, and I think you have really great insight into this since you have been deeply involved in Cosmos for a long time and have seen many iterations of what is now sort of like the roll-up as a service approach. What are your thoughts on this?
So I think that like one of the things that has been a challenge a lot of DeFi, I think, in general, struggles. So there's like lots of mystery pieces, like who are the liquidity providers? Who are the liquidity providers? Who are the traders? Where are the demands? So like in DeFi, you're like growing in the dark. And then there's this challenge of, build it and they'll come. right? Like a lot of teams, I think a lot of where I contribute in a lot of things is like, I am willing to keep trying go-to-markets until something works. And have been doing that across many different protocols and try to do it in environments that are frequently very challenging. And so, we built, there are a lot of cool DeFi things that have been built in app chains. I think delivering those to the market has been just like a considerable challenge. The work that Cosmos collectively had to do to, for instance, support DYDX in terms of coming into Cosmos was enormous. We got USDC launched. We added new features to the consensus engine. We did all kinds of new stuff just to support that single DeFi use case. And DYDX has had a modestly successful go-to-market, but I think that we all expect more and we all want more. Go-to-markets are incredibly challenging, and you can build the coolest protocol in the world, but if you don't find a way of drawing users in, and this is the supply side of assets to trade, et cetera, that all of these tokens, every DeFi protocol relies on. We need new things that users will get excited about in order to bring volume, liquidity, TVL in. Otherwise, we just kind of spin our wheels, and we can't be, we don't own the full supply chain.
Are DeFi founders actually evaluating building on an L1 versus an app chain from a technical perspective? Or do you guys think it's purely go-to-market in the sense where if you launch your own app chain, there's utility now for your token?
So before that, just want to give a big flowers to him. Building DeFi on Cosmos is hard. It's playing on fucking hard mode, man. It's the number of variations there and the number of user fragmentation there is insane. Just flowers.
It is.
Bro.
The question about L1s and utility for your token, if you launch an app chain, Cindy, you chose very early on to launch on Solana, and you guys have stayed very loyal and true to Solana. I'm sure you've had to have that conversation with your co-founder. Should we launch our own app chain? Should we or not?
The biggest consideration for us was, one, do it in a go-to-market environment that's actually conducive to your success. I think the biggest reason we chose Solana, one, was that it was actually the only chain available besides ETH L1 in 2021 when we started building. Arbitrum didn't exist at the time, and Solana presented itself as pretty compelling L1. We saw early bubblings of a developer community there. It was still very much chewing glass early days. People didn't know how to build programs, so everyone was supporting each other. But we saw the very early innings of a community that was supporting each other and launching programs, and we thought, okay, these are the users, these are where they are right now, so let's go to and build where they are going. So obviously that was one big developer and user base for us to launch into. Second was the availability of capital. We didn't think that it made sense for us to bootstrap an entire chain with 0 assets on the ground beyond what we would deploy. And Solana was growing a lot in TVL at the time. I think back in 21, it was still in the 100, 200 million range. Now it's closer to the 5B TVL, so just shy of 10x from ETH. But having a asset base with other creators of assets launching meme coins, tokens, creates a fertile ground for a DeFi protocol, right? You can't really launch a DeFi protocol without a home or real estate for you to be servicing. So it's kind of the decision of, should we launch in New York or some random small country that nobody knows about, or the city that no one lives in. So that was to us a decision to launch into a place where people needed this service versus launching someone and then forcing people to come to you. So in essence, we do think that app chains offer some tech innovations, but Solana in particular, we're seeing a lot of growth on the tech side, Firedancer, validator client upgrades. So we think that trade-off will equalize itself in about a year's time.
Why would a perp or a DeFi protocol launch their own app chain? What do you think are reasonable?
I think the honest answer is you can build some gigabrain shit on an app chain. That's the
give an example.
What's an example? The nerd snipe of building on an app chain is the gigabrain stuff. The DYDX built on top of Cosmos is like the fastest execution of any perp DEX that is out there right now. And like that, being able to build those metrics. The other thing you get is this ability to like sort of clean slate build up a ground up environment. You've seen DYDX do this, you've seen Hyperliquid do this, you see what Berachain is doing. All of these things are leveraging this ability to like be an app chain to like, structure and incentivize an ecosystem with no preconceptions whatsoever. And that appeals to people. Like it appeals to capital, it appeals to people. We are all experiencing the Berachain hype cycle, the Hyperliquid hype cycle, like all of these things. And who knows if it works, but there's a scale, there's an ambition, there's a technical complexity that applies to people. I mean, I think a lot of DeFi builders, a lot of it is just like, we want to show that we can. Like we can, like that something like this could exist.
Mm-hmm.
So question for you, I'm very curious, like between DYDX and Hyperliquid, what's your take, like technically? Like technically, Hyperliquid and DYDX, what's the difference? And like what's better?
Yeah, so Hyperliquid is a more conventional, like on-chain like CLOB design. Hyperliquid is this like really cool, DYDX is in this really cool mem CLOB idea. Sunny and I actually dreamed up the mem CLOB vision like in 2018, and then neither of us built it. And then DYDX came up and we're like, we want to build a mem CLOB. And they looked at every possible technology that was out there in the entire crypto ecosystem, and there's like, well, there's only one thing that we can build this on, which is the Cosmos stack. And they wanted to build it, so they built it. And they were like, we're gonna like, eat glass on the go-to-market and like solve all these other problems of user onboarding and wallets and all of this other nonsense that they're dealing with now. But the mem CLOB concept is really cool, and being able to do it in a fully decentralized setting is a pretty powerful thing.
That's a great example of a difficult decision that a DeFi founder had to make. And I remember it was certainly not consensus that was the right move by DYDX at the time. And it took a long time, and now here we are. And it's
Drift is the only perp DEX in the top 3 that is not a app chain.
Fascinating. That's huge.
Also a difficult decision, to be honest. I think, especially, difficult non-decision.
Or maybe not an app chain yet.
As we're coming up on time, there are 2 questions that I think very rarely on panels are actually discussed that I want to ask you guys. The first one is, why do you think there are more sellers than buyers right now? And how are you guys converting and retaining users in this market?
I'll give you my answer, which is one of the hardest things about DeFi is we have apps that people use, and then we have tokens. And token is a separate product from app. Mm-hmm. And you, as a DeFi founder, you end up with 2 or 10, but like the token is the N+1 product. And it is a little bit of a struggle. If you are a meme coin, all you have is token. Like you put all of your energy into token. If you're a DeFi protocol, you have like all of the things about a DeFi protocol, all of the things about an actual app, and then you have token. And I do think that like this is like one of the reasons why it's hard for us to clearly articulate why people should be buying DeFi tokens.
Do you 2 want to add on there? Perhaps around converting and retaining users as platforms that primarily offer perpetuals.
I think incentives can only get you so far. Like you can spray token incentives as far as possible, but the moment they stop, if your users don't actually like your product or you're not solving a need, that's like the clearest way to tell that a user doesn't need it. I think the easiest way is really to go down very, very basic like grassroots. And DeFi protocols, like once you get to a certain point, probably don't do this enough. Like, do you know who your top 110 users are? Have you actually built BD teams that service these people and like make sure that they're coming back, keeping their capital on the platform? But that plus just constant pushing out new experiments that users might like are probably the easiest like retention methods. Well, not easiest, but the most obvious ones.
Yeah, I'd love to hear your thoughts on this, particularly because within the Solana community, you're such an iconic figure, and I think a lot of Yeah, you. I think a lot of the reason why people are attracted to the Jupyter community and stay in it is because of the work you've done on the software side of things with community.
I think the answer to all three things is love.
Okay.
Like love. No, I'm not kidding. I'm serious. I'm very serious. I think you have to love your users. You know, like really care for them. You know, like we spend so much time on like problems you wouldn't imagine, right? Like we probably spend like I think easy like I don't know like half of our operational thinking is on our users, right? And you also gotta love LPs, right? You know, because for personal stuff, there's always a big LP pool. Take care of them, right? So there's always like and people, and so you got to take care of the LPs as well, right? You know, and you got to understand that they put their life savings in there, they really concern about stuff, and you really gotta like take their love, right? And community too, right? You really have to love like engaging the community, right? So I think and really talk to them, and if they're frustrated at token price, you have to be empathic with them. You have to just talk to them and just talk to them. So I feel like if you do everything very nicely, you love your users, you love your LPs, you love your community, then ideally, hopefully, right? Then the virtuous cycle comes in, right? The users provide fees to the LPs provide liquidity to the users, and they because they love your product so much, they become community members, right? And I'm saying, right? And then so I think that virtuous cycle sets in, right? So I feel like that's how we think about it anyway, right? Because I mean, guys, I'm telling you guys, I mean, it's so fucking hard, man. Seriously, I mean, if you don't hit the flywheel, right, whereby your product and your liquidity and your users and your community, right, are in sync, right, it's painful. It's fucking painful. I don't even think it's possible. Yeah, that's it.
For some reason, I just keep doing this over and over and over again.
It's an addiction at this stage.
Oh, good. Oh, good.
Zucky's involved in more than 10 projects at any given time.
Yeah.
Dude, I was part of the early Ethereum wars as well, man. Ethereum, like DeFi wars and stuff. I mean, I started WPTC, right? And also I was involved in like Kyber incident, right? Dude, brutal, man. It's like every new ecosystem is a new war, right? And it's also like it's also frenemy kind of thing, right? Right? Whereby it's like you have you talk to each other improve, and it just ends up at a given place. But the journey there is brutal, Yeah.
I think that's a fantastic note to wrap up the panel on. Part of why I was so excited for this is because I have the privilege of working so closely with founders and have picked up those 2 a.m. calls when they're making very, very difficult decisions. And as you three have talked about throughout this, it's the difficult decisions that have led to some of the most important moments, like those inflection points for the entire category of DeFi. It's also very fun, and clearly, like Zucky, for example, you continue to take on crazy side projects, side quests, and for you two, I know it's a very fun undertaking for you both. So thank you guys all so much for being generous with your thoughts.
Can I say something real quick? Just real
very quick, yeah.
Really quick. So I just want to say, like, if any Seb is here, awesome. James is here as well. So if anyone is watching in the Jupyter community, thank you so much. I love you guys. Yeah, that's all.
Oh, okay. Well, thank you guys.
Seb.
Thank you.